Okay, thank you to everyone who's joining. Good morning to those on the West Coast. Good afternoon to those on the East Coast. Thank you for joining our webinar on cash confidence in uncertain times. So we're going to start with a few housekeeping items. This webinar is going to be recorded. The whole thing will be downloadable. It'll be sent to you within a couple of days. So you'll have access to all the discussion and I believe the notes as well. Second is CTP credit. All attendees of the full session will get 1.2 CTP credits from AFP. If you check your email confirmation after the webinar is over, you'll get the confirmation for those credits. Next is questions. So if anyone has any technical questions or business questions, you don't need to wait till the end. You can shoot questions in at any time throughout the webinar. There should be a button on the bottom of your screen that lets you ask a question. Again, if it's technical, video problems, sound problems, that'll be answered immediately. If it's a question for the speakers, shoot it in and we're going to leave 10 or 15 minutes at the end for Q&A. So go ahead and submit your questions anytime. If we do run out of time, we'll make sure to email back responses to the questions that we can. Okay, so our agenda. Thank you again to everyone for joining. We're going to start with introductions of the speakers. That's myself, the moderator, and our two panelists. We're going to talk about a really unique survey that we did of corporate treasurers. And then we're going to touch on some of the tools that treasurers use for cash management. We'll touch on bank accounts, FDIC insurance. We're going to touch on money funds. We'll look at best practices for evaluating funds. And then we're going to dig into U.S. Treasury bills. And as I mentioned before, we'll have some time for audience Q&A. So our panelists, I'll introduce myself first and then go to the panelists. My name is Chris Murray. I spent 14 years as an equity and quant trader, first at Goldman Sachs and then at JP Morgan. I had the honor to start my career right in 2007 before the big financial crisis. That was a great learning experience. And for the last 2 years, I've been the head of trading at Jiko, where I primarily trade treasury bills. And we seek to make treasury bill ownership easy and seamless for our clients. Now I'm going to hand it over to Sean.
Yeah, Chris, thanks for having me. Really appreciate it. And thank you to the whole Jiko team. It's a pleasure to be joining you this afternoon and speaking with the audience. So yeah, my name is Sean Healy. I'm the head of product sales for Fund Connect. For those that aren't familiar, Fund Connect is State Street's money market fund trading platform. My team is responsible really for helping our clients manage the complexities of their short-term liquidity investing. Prior to joining State Street, I was at Credit Suisse for just over 14 years. Like Chris, started my career at the tail end of 2007 and navigating those complexities. I did a brief stint at a crypto trading firm, and so I've been through a couple different crises now, and but happy to be in the cash space and looking forward to speaking with you all.
Good morning and good afternoon, everyone. My name is Scott Richland. Until the end of last year, I was the Chief Investment Officer at the California Institute of Technology, or otherwise known as Caltech. I'm currently on the board of directors of Jiko. And prior to Caltech, where I was there for 14 years, I ran a family office for an ultra high net worth family. And prior to that, I was a banker at Citibank.
Okay, thank you very much, Sean and Scott, and thank you for being here and spending your time to do this webinar. So I want to talk briefly about a survey that we did that partly inspired this webinar, and part of the reason we're doing it is to share some of the results. So this spring, we conducted a survey of treasury and financial professionals collaborating with State Street throughout the spring Treasury conference season. We got over 190 people who are senior executives in this area in the spring, and it's generally weighted towards larger U.S.-based organizations. Our goal was to get a sense of how comfortable people are managing their cash in times of crisis. This isn't for the random Tuesday to make sure your bank account's working. This is for if there is another financial crisis, when things get hairy, how comfortable people are with their strategy. And throughout the course of this presentation, we're going to share some of the results of the survey, and we'll use that a little bit to guide the discussion. And it's important to note that afterwards, we're going to send out the complete results by email. So everybody's going to get the relevant summary of this. Okay, and we're going to start with a audience poll question. So logistically, if attendees who are logged in, all you have to do is click on the button here. Simply click on A, B, and C. That'll go through, and we'll be able to see the results in the next slide as they come in. But while we wait, so we're asking people if they're the primary decision maker for managing their corporate cash, if they're a contributor but not the decision maker, or if they're not involved and simply here to learn. All of those are fine. We're just interested in learning who's attending. And if I could ask Sean, what among your clients who talk to you about money funds and other things at State Street, what's their mix? Do they tend to be the ones making the decision, or are they educating themselves so they can help inform others?
Yeah, Chris, we really see a mix of all three of these categories. I think primarily A and B, but really it depends on the size of the firm and kind of the complexity of the organization and the amount of cash that they're managing. At a number of larger firms, we'll typically see an investment team that's really focused on making those portfolio decisions on behalf of the organization, and then kind of passing that down to the kind of treasury operations team or cash management team to actually place the trades and manage the liquidity across all the different counterparties. Smaller organizations, that's typically more centralized. So it's more of somebody making the investment decision and placing the trade and managing liquidity.
Yep, that makes perfect sense. Thank you. Okay, so we've got 65% submitted. Thank you for people who submitted their responses. Let's see what we've got here. Okay, this is a very good mix. So we're almost very close to evenly split between primary decision maker, somewhat contributing, and not directly involved. My guess is some of this reflects organization size. I would guess that larger organizations, like you said, Sean, are just people who are educating themselves. And maybe there's some people who are just attending this webinar for educational purposes, which is great. Okay, so one of the nuggets that we gleaned from our corporate confidence survey is that only 27% of respondents said they're very confident in their current approach to safeguarding cash in a crisis. And one of the reasons we're bringing this up is that it's been a long time since we've had a true financial crisis. I would say 2008 was the last one. There were market stresses during COVID and during the tariff tantrum, for example, but those didn't really approach crisis level. And we think it's important for people to realize that organizations can be negatively impacted, even if they don't have losses, if they simply lose funds availability for a few days. And some of the anecdotes that we'll touch on throughout this webinar are people who had problems because they lost access to their funds, even though they ultimately never actually lost funds. So another item we'll turn to before we flip to talking about banks is that the majority of people rely on bank strength and FDIC insurance to ensure liquidity in a financial crisis. We had some options for what people turn to. This banks, money funds, and others, and banks were certainly the most popular. And 100% banks and FDIC insurance will always play a role in corporate cash management. And we're going to talk through some of the risks and benefits associated with banks and FDIC insurance. So with that, I'll turn to Sean to talk about how people think about bank accounts in their cash management strategy.
Yeah, thanks, Chris. So I don't know, some of you may have seen yesterday, actually, the AFP 2025 liquidity survey was released by Invesco. And taking a look at that really speaks to this point, kind of what we just saw in terms of Jiko survey. So according to the AFP survey, 80% of short-term investments are in short-term investments of deposits, money market funds, and T-bills. And of that 80%, roughly 50%, just under 50% this year, are in bank deposits. So, bank deposits are still far and away the number one place that corporate practitioners park their cash, for obvious reasons, like it's very liquid, easy to get your funds out, same day liquidity, of course. What's interesting is the FDIC insurance being noted as an important factor when most firms are parking well beyond that $250,000 insured limit with their banking counterparties. There have been a couple of, more recent years, there's been a couple of innovations and and some fintechs that have been developed to help spread that cash and kind of act as like deposit sweep networks across FDIC, to keep the investment level at just under that FDIC insured level, to maintain that safety. But I think we really haven't seen, to your point, there hasn't been a true crisis in quite some time. So I haven't really seen those tested yet. And I think, to your point, last year time just flies, 2 years ago when we had the regional banking crisis and kind of like spring of 2023, certainly Silicon Valley Bank, Signature Bank, First Republic impacted, but even more recently than that, and early last year, regionally, where I'm based in New York, there was concern with the New York Community Bank and some of their exposure. I think what's important when looking at banks and most of our, I'd say most practitioners these days are typically dealing with, GSIBs and ensuring that they're, banking with the highest quality counterparties that they can. We're really undertaking a look and understanding what's on the bank's balance sheet, right? And that was the case with NYCB last year. There's a lot of commercial mortgage exposure, and given the uncertain rate environment, what that was going to look like. So, Scott, I think you might have had some direct experience with SVB. So, I don't know if you'd like to comment on that.
Yeah, I mean, what was interesting with the Silicon Valley Bank situation is the bank itself was considered a relatively strong, safe bank, but the issue that affected them was their huge concentration in firms that were backed by venture capital and to some extent buyouts that were depositors within their bank. And when the issues with Silicon Valley Bank came up, there was somewhat of a run, and they were not able to deliver all of the cash that was requested. And I, as the chief investment officer of Caltech at that time, with some exposure to venture capital, was very concerned that our portfolio of venture capital companies literally were not going to be able to open for business on Monday morning because they didn't have access to their cash. They weren't going to be able to purchase product or make payroll or whatever it was that they needed their cash for. As it turned out, the government came in and provided liquidity. But it's an example where an institution that you believe is relatively safe all of a sudden can become problematic if there is a run on the institution, which there was in this case. And of course, we also know that it became somewhat it became influenza, if you will, because that then led to runs on a couple of other institutions that people believed were similarly situated in terms of the concentrations.
Yeah, but I'll give you my personal anecdote on that situation. That I joined the State Street and the Fund Connect team the Monday after the FDIC took control of Silicon Valley Bank. So walking in day one, and just, everybody was dealing with the fallout, and frankly, the team was doing a great job helping clients open up accounts, to be able to invest cash as they were kind of pulling out from various different banks. So, it was an eye-opening welcome to the cash business for me, if you will.
Okay, thank you. I'd love to know, Sean or Scott, what moves have you seen clients make after that? I guess one possibility is move more cash into the GSIBs out of the smaller banks. Another possibility is spread cash out among different smaller regional banks. And a third is just get out of the banking system and, money funds, T-bills, et cetera. So what kind of changes have you seen make?
I mean, it certainly hasn't been getting out of the banking system, right? We just talked about how critical that still is to everyone's investment practice. But I do think there has been concentration, with the GSIBs, right? And with, what corporate practitioners would probably consider their core banking partners. Just truly, I think there was a kind of a somewhat of a niche clientele that SVBs and the First Republics and the Signatures cater to, and those practitioners, those companies have had to find, kind of core banking partners within that GSIB community.
Yeah, as you might imagine, we did quite a bit of debriefing with our venture capital partners. And one of the things that led to the problem was that these venture capital firms had very strong relationships with First Republic and Silicon Valley Bank. And in fact, they asked their portfolio companies to bank with SVB and First Republic. That has since changed. In fact, the venture capital firms are now requiring their portfolio companies to not have a concentration with one particular bank and have their funds spread around at least 2 or 3 banks.
Oh, that's interesting. Certainly reasonable responses to the crisis. I'm curious if either of you see clients distinguish among the GSIBs. Are they doing that kind of deep dive into their banking counterparts, or are they sort of distinguishing as the big globally systematic important banks are in one category and everyone else is in a different category?
Yeah, I've not seen that distinction necessarily from our clients. I think it's more of the latter that you described, where you've got this tier, A of GSIBs, GSIFIs, and then there's everybody else. Scott, I don't know if you've got a different view on that.
No.
Okay, got it. That certainly makes sense. And as Sean, what's your view on, to the extent you have it, and how sweep networks have evolved over time, and the extent to which they might act differently in a time of stress?
Yeah, I mean, I don't think we really know how they're going to act in a time of stress yet. They're relatively new, right? And kind of utilize sort of a central clearing model of funds that then gets dispersed to the end banks where the FDIC insurance is. But yeah, I mean, we really haven't seen them, so it's kind of hard to say what necessarily would happen, how they're frankly their infrastructure would be stressed if there was like a mass drawdown. So hard to say.
Sean or Chris, you might actually want to define for everyone what a sweep network is, because not everybody may be familiar with the product.
Yeah, so sorry, the sort of my one sentence description would be, it's a way for a client to have their funds spread across multiple different bank accounts automatically to benefit from higher FDIC insurance. And I think, Sean, correct me if I'm wrong, but clients can get many millions or tens of millions of FDIC insurance by using these networks. Is that right?
That's right. Yep.
Perfect. Okay. Thank you. Thank you very much. So I'm going to turn to another item from our corporate cash confidence survey. Now we're going to move on to money market funds. So we talked about banks. Banks are certainly the most liquid option that people have for cash management, but we just described some of the safety issues. Per our survey, 34% of people rely on money market fund diversification for liquidity and principal safety during a financial crisis. So this is our second most common approach to safeguarding cash. Certainly, people are generally aware that the yield of money market funds is often in excess of bank accounts. So I'm sure that's a driver, but it's also a diversification argument. So we're going to turn to Sean to give a high-level description of the different types of money funds and how they work.
Sure. Yeah. So when we're talking about institutional investors, right? I mean, there's really 3 primary categories that people care about, and we'll, I'd say these days there's really 2, but we'll talk about 3. As you see here, there's treasury funds, government funds, and then prime funds. Within I think an important distinction to make is, and we'll get into a bit in terms of the holdings and what these what the portfolios are that the funds actually manage. But for treasury funds, treasuries and treasury-backed repos, government funds, same concept, but you can add in government-sponsored entities and government agencies. And then with prime funds, there's commercial paper, CDs, notes, asset-backed securities, other instruments. I think what's important these days too, when we talk about treasury funds, it's typically split between treasury-only funds and then treasury plus. So treasury-only will not have that repo component. They will only be investing in U.S. Treasuries. The Treasury Plus funds, as you'll hear, will include that repo element as well. And then within government funds, it's really, like I described, Treasury, kind of that Treasury Plus the agency exposure there. I think, talking about prime funds, so most people are probably familiar. There was a recent round of money market reforms that went in effective last year. It did a couple of things, for one, applicable on all funds. And really, the idea of the money market reforms was to really, improve safety and security and provide better liquidity in a time of crisis for investors in money market funds. For all the funds were impacted by the changes to the daily and the weekly liquidity, where funds, their daily liquidity measurement had to go from 10% to 25%, and their weekly liquidity had to go from 30% to 50%. And that had a knock-on effect that I'll talk about in a second. Redemption gates on funds were removed. Liquidity fees, discretionary liquidity fees were introduced. And then importantly for the prime funds, mandatory liquidity fees were put in place under a 5% drawdown on a given day. And really the change in liquidity measurements and the mandatory liquidity fees on the prime funds have really drastically reduced the attractiveness and availability of prime funds to institutional investors. If you look at the overall money market fund assets, it's around $7.3 trillion. There's about, in institutional funds, there's about $2.5 trillion in government funds, $1.5 trillion in treasury funds. There still is, about $1.3 trillion in prime funds, but from an institutional perspective, it's under 400 billion. So it's really the changes that went in place last year, whether, some asset managers either converted their prime funds or closed them altogether. There are a few that are still out there focused on institutional investors, but largely the primes that exist are for retail investors.
Okay, thank you. And is it fair to say in the slide we have here that it goes from the most safe to the least safe as we go from the top to the bottom, or the least risky to the most risky?
That's probably a fair statement, yeah.
Okay. Is there much yield pickup as people go to from treasury to government to prime? Like, is there some compensation?
There's not much of a spread on the treasury to govy funds, frankly, particularly with the repo elements in there. The prime funds you're looking at, maybe at most a 20 basis point pickup.
Okay, so so the yields are different, but not drastically so.
They're not, and then the other factor too, when it comes to yield, which we'll talk about, is the expense ratios, and those vary quite dramatically on, depending on what the fund is and which share class you're in. So that can have a more meaningful impact, frankly, on the yield than the underlying holdings.
Okay, and I've read a lot about these liquidity fees on big redemption days. That's always in the literature, but do you know if those are frequently charged, or have there been instances where funds had to charge those fees, or is that kind of a theoretical that they put in?
It's a safeguard. I may have heard of one instance where it was calculated but not actually implemented on a prime fund, but they're safeguards. I don't think they've actually been used.
Okay, great. I appreciate it.
I guess I would just add there, Chris, that with most of these things, the time it will be implemented is exactly when you don't want it to be implemented.
Precisely. Well, and look, that is, and Scott, to your point, that's why the asset managers that have either closed their primes or converted their prime funds was because it's frankly just too operationally complex to manage those mandatory liquidity fees, and it's not worth, given the asset size, and it just wasn't worth the effort. So yeah. It had the unintended consequence of really, I say unintended, but probably not, had the consequence of really, reducing the number of prime funds available and the overall assets in the space.
Yeah, that makes sense. And we'll just remind the audience that money funds are always pooled funds where every investor holds a share. So if there's a massive redemption, then the fund has to sell certain securities and it's stuck with other securities. And the leftover investors in the fund have those leftover securities. So money funds are quite different from direct ownership, because with money funds, you own individual shares of a fund as opposed to owning, for example, individual T-bills or individual treasury-backed repo. So there's one question that I'm happy to touch on now because it's relevant. Can you just, Sean, briefly describe what is a liquidity fee or what is a redemption gate for people who don't know?
Yeah, sure. So, I mean, the redemption gates, which were revoked, were literally a fund's ability to say, no, sorry, you can't redeem anymore today. That no longer exists. So now this concept of fees is in place. And really that's taking a look at, and there's different calculations, but taking a look at what the outflows are from a fund on a given day. I think, like I said, I think primes, it's 5% they have to look at for that mandatory liquidity fee. But taking a look at the overall outflows versus liquidity of the fund, and it doesn't always necessitate a fee being imposed, but if there is a fee imposed, it's imposed to the shareholders that have placed redemptions, right? So theoretically, it's effectively charging them for taking their money out of the fund. For those investors that stay in the fund, they don't get charged the fee.
Okay.
Well, and the reason they put those in place is in times of crisis, if there is if there's a run on a fund, they may not be able to liquidate their securities at par. And so they may have to sell them at a slight discount, and these fees help reimburse the remaining shareholders for the discount that was incurred as a result of providing liquidity to those who redeemed.
Yeah, and Scott, I think that's an important point. And when I was first talking about the prime funds and then the implementation of the money market fund reform, to your point, by increasing the liquidity requirements daily and weekly, really impacted the prime funds, because given the other instruments it can hold, really impacted their ability to, liquidate when necessary under times of stress. So those two things, again, have kind of led to the decline of primes.
Okay, thank you. And is there still any talk of having a floating NAV, or is that kind of put to bed for the time being?
Well, there is a mechanism whereby, and I don't know the specifics, apologies, but there is a mechanism where a fund can convert to a floating NAV rather than implement a fee. And then in non-US money market funds, there's still a fair number of floating NAVs.
Okay, thank you very much.
Yep.
Okay, so
I would say nobody wants a floating NAV.
Yeah, fair. No, it makes sense. A dollar is easier to understand. So now we're going to turn to our second audience poll. Again, you just click your vote on the slides. And it's, what is your biggest concern when evaluating a money fund today? Is it credit counterparty risk, liquidity under stress, lack of transparency into holdings, operational or complexity or delays, or yield? And just a reminder to the audience, money fund yields are always stated after fees. So they're always yields net of fees. And Sean, what do you think clients look at most when you're consulting with them on money funds?
Yeah, I mean, look, from a safety perspective, right? And look, it's going to depend on, what each firm's investment policy statement allows them to do. But generally speaking, from a safety perspective, size of the fund is kind of most important. And typically size of the fund is correlated with the GSIBs and GSIBs we talked about that operate an asset manager who's running a fund. Not always the case, but there's a pretty high correlation. But size of the fund is pretty important. And then once you kind of narrow down that universe of funds that you're willing to take a look at, it's really the yield. And like I said, there's the yields can be impacted significantly by what the expense ratios are. To your point, clients are looking at net yields, but it's first it's safety based on size of the fund typically, and then because you made the point about being commingled, nobody wants to be an outsized percentage of the overall portfolio, and then the yield.
And Scott, what were your main?
And Sean, well, I was just going to say there's really two levels to the credit or counterparty risk. The first that is people probably think about the most is the credit quality or the safety of the manager of the money market fund. So you may be comfortable with the fund because it's run by a Fidelity or it's run by a JP Morgan. The second level of credit or counterparty risk is what's within the fund. And just because it's a treasury fund, as we'll talk about in a minute, doesn't mean that there is not exposure to entities other than the US government.
Perfect. Thank you. So thank you for that, all that context and information. We'll flip to the next slide here, see what the poll results are. This is pretty interesting. Okay, so no one's really concerned about transparency in holdings. Few people concerned about operational complexity or delays, but it's really credit or counterparty risk, liquidity under stress, and yield.
Yeah, and I think we're getting to this next, but Scott, to your point about the holdings of the portfolio itself, clearly people are not, or at least that's not a concern, is lack of transparency. But I know, Chris, that'll be our next topic.
Yep, I think so. So what do you know? So this is, again, going back to our survey, only 16% of professionals regularly review the detailed holdings and counterparties of their money funds. And this is the point we made about transparency. And what Scott was saying is, in certain funds, you do have exposure to entities other than, for example, the US government for treasury bills.
Unknown caller.
Apologies for that.
So next we're going to talk a little bit to the actual security types underlying the funds. So previously we described the types of funds. Now we're going to get into the weeds of the securities held by those funds. And we're going to ignore commercial paper for now because prime funds, as Sean said, are far less popular. So we'll focus on treasury bills, repurchase agreements, agency securities, and really make sure people understand what these actually are. So I'll hand it over to Scott for what are treasury bills.
Yeah, thanks, Chris. So treasury bills are obligations of the U.S. government. They're short-term. A T-bill is an instrument that matures within a year. They're offered in various maturities, but the whole group that are less than a year maturity are called T-bills. It's considered one of the safest securities that is available within the world, and they are extremely liquid. So I happened to look up just this morning how much in T-bills were traded just yesterday. In yesterday, there were approximately 68,000 trades in T-bills for a nominal value of nearly $200 billion. So it's if you need to liquidate your T-bill within a matter of seconds, it generally can be done pretty easily. The other nice thing about T-bills, at least in this current environment, is that they're generating a nice rate of return. Current yield is for a 4-week T-bill is about 4.25. Now, that's not to say that it's always at that level. If you go back a few years ago when we were in a much lower rate environment, you would see T-bills as low as 25 basis points or 50 basis points. But right now they're particularly attractive. The other thing to consider is, as you know, with bonds, the farther out you go in maturity, the more interest rate sensitive they are. So a 4-week maturity has virtually no interest rate risk. You see very little variation. Even if interest rates were to move, because the duration is so low, you would not see very much movement in the price. As you go out further, for example, to 1 year, you might see a little bit more movement in the price if there was an extreme movement in interest rates while you owned that security. And I guess the last thing I'd note is that even during April, this year when there was a big sell-off of the long-term treasuries as a result of the views of how tariffs might impact the economy. There was virtually no impact on the short-term treasury. So you definitely saw movement on the long end of the curve, but on the short end of the curve, it was really de minimis.
I appreciate it, Scott. And certainly it's important to distinguish T-bills from longer term treasuries. A few months ago, there was a lot of scary newsprint about the basis trade where there's a lot of leverage in treasury trading and treasuries sold off a lot. And all of that I read was referring to the longer term treasuries that did sell off. And throughout all of this, T-bills were just a calm in the storm. And certainly worth noting that T-bills are a big investment for Warren Buffett. I think he owns like 300 billion, something like 3-4% ish of the outstanding T-bills. So they're very well, they're very popular with him.
I chuckled when Scott said current environment because, as we probably all know, the Genius Act passed and stablecoins have now been blessed. And it'll be interesting to see what impact that has.
Yeah, 100%. That would probably be a good webinar above and beyond this.
Yeah, we'll get it 6 months.
Okay, next we're going to turn to repos, and if it's okay, first I'll turn to you, Sean, to just give a high-level view of what exactly repos are.
Yeah, sure. Not a repo trader, but effectively you're borrowing cash or securities and backing with collateral, whether that's cash or securities. In the case of the fund, it's typically you're long cash and you're lending that out and backing it, or you're receiving securities. I think what's important to note here is, and Scott will touch on this because he mentioned it in terms of the portfolio composition, but money funds have access to the Fed overnight reverse repo window, which is important. They can enter into repo transactions with a number of different types of counterparties, whether it's banks or other financial institutions. But call it 2022, 2023, there was significant usage of the Fed's overnight reverse repo window. That's come down dramatically. I want to say it was around 2.3 trillion at the beginning of 2023. Now it's around 500 billion. So that kind of backstop has really come off, and it's back to kind of the traditional model of who the funds are doing business with.
Yeah, so one of the things you'll see when you actually peer into many of the Treasury money market funds are these repurchase agreements. And just to go a little bit deeper into how they work, a bank, for example, may want to borrow overnight. It will post generally collateral, treasury collateral equal to, let's call it maybe 103% of the amount they want to borrow. And they'll put that collateral up, and then they will get the cash, and then the next day they will either roll over that repurchase agreement or they will repay. We keep calling it borrowing, but in fact, it's an agreement to buy and sell back the securities. But it looks very much like a borrowing. What you'll find, though, when you look into these funds, not surprisingly, the banks that are willing to pay the highest rate on that borrowing are those that maybe don't have as much access to other forms of borrowing, or maybe riskier. So what you'll see is a lot of foreign banks, often, and I'm not saying just because they're foreign, they're less safe, but in my experience, you'll see French banks, Canadian banks, German banks, so a lot of European and non-US banks on those repurchase agreements. Repo is considered generally safe, but it's not the same as holding the actual securities. You are depending on that counterparty, so let's say the French bank, to actually pay you back the cash. And if they do not pay you back, then you have recourse to that collateral, but it's an extra step that you have to go through in order to get the money back. And if there's a bankruptcy in the interim or some other event that disrupts the market or disrupts the liquidity of that particular institution, you may not get your money back immediately. It may take some time. It may have to go through some legal process. And again, that's just another step and something that can disrupt the liquidity of your money market fund.
Yeah, I think what's important to note here, Scott, too, and we've talked about it a few times, and we'll continue to talk about it, but when you think about the safety of the money funds and what the holdings represent, we talked about some of the survey results around folks not really looking into what their money fund is investing in. It's something I encourage practitioners to take a look at so that they know. They know ultimately what they're holding, right? And to your point, whether it's, tying it back to the SVB example, there are plenty of funds that had repo trades on with SVB, right? And some of the other banks that we talked about. And a client, a practitioner who doesn't bank with them might not think they had any exposure, but their fund did. And there are tools available that can help practitioners identify what their actual holdings are. That's really powerful information. Most people don't pay attention to it until it's a time of crisis, and then they want to say, "Oh, what do I actually have exposure to?" Whether that's a banking crisis or a geopolitical event results in some regional disruption. To your point, a lot of foreign banks in these reprograms. So the information's out there. The funds are required to publish their holdings on a monthly basis. Like I said, there's tools available, to help clients identify what those holdings are.
And I can, and just briefly, I can tell you at Caltech, when we were evaluating our treasury funds, we looked at both who the counterparties were, but even more importantly was the concentration. We wanted to make sure that, no more than, in general, no more than 5% of the fund was exposed to any one institution. And when we found larger concentrations, frankly, we would either reduce our exposure to that fund or maybe even redeem entirely to that fund until we got more comfortable with the various exposures within that fund.
Thank you. That's fantastic information. One question: people can find the holdings on the fund's webpage, and Sean, is it fair to say some platforms, maybe State Street, would let people see aggregate holdings across funds?
Yeah, I was trying to avoid pushing our own product, but yes, there is. Most dedicated fund portals have a look through into the.
Okay, great. So I'm going to go quickly through the last security type here, which is agency securities. These are debt obligations issued not directly by the Treasury, but by government-sponsored entities. And some of these do actually carry an explicit government guarantee, such as Ginnie Mae, and some don't, such as Fannie Mae and Freddie Mac. These are generally considered low risk because they are government associated, but they are typically going to be viewed as more risky than treasuries. And I think they might have a little bit less liquidity than treasuries in the case of a crisis. Here, I think the main thing that we'd want to look for is what percentage of the agency securities are actually explicitly guaranteed versus not explicit, versus an implicit guarantee. And that's the kind of thing that when it's not a time of stress, that isn't going to be a big deal. But if people got concerned again, for example, about what's going to happen to Fannie Mae, then those securities get traded at a discount. So this is going to be our last audience poll. We reminded people in the beginning that it's been a while since we've had a legitimate financial crisis. So if people here could just answer, were you working in a role similar to your current one during the 2008 financial crisis? I can speak for myself. As I mentioned, that was literally my first year on the equities trading floor, showed up as a young analyst. My boss described me as a pimply-faced kid from Carnegie Mellon who couldn't tell a bid from an offer. And I certainly learned a lot during the first 2 years. But it was a formative experience. I think I really evaluate risk differently because I went through it. So Sean, tell me a bit about your start in the financial crisis.
Yeah, I mean, I started at Credit Suisse in November 2007. I was working in a very different business in the futures clearing group, and really it wasn't until 6 or 9 months later when things got crazy, when Lehman effectively was being unwound, and I was working from 6 o'clock in the morning until 10 o'clock at night, and then doing it. We did that for like 5 weeks straight. So it was a very, very interesting time to be starting a career.
Yeah, I was not starting my career. I was running the family office at the time, and I have to say, I was, to me, this was the worst financial crisis that I had gone through, and I had been in 87 and 89 and 92 and 98 and 2001. So I had been through quite a few. The 2008 financial crisis, I was very concerned that because it was a liquidity crisis, and because it affected so many financial institutions, that we could just see a complete meltdown of the financial system as we understood it. Luckily, as we know, again, the government came and bailed out many institutions and prevented that complete meltdown. But I was definitely concerned that it may change the global financial system as we knew it.
And you were correct.
Okay, thank you. Interesting. All right, so we have a majority of people who actually were in the seat during the financial crisis. That's interesting and good to know. Certainly the trading floors I've been on, if I pulled the floor now, the number would be that 75% of people were not in their seat during the financial crisis. So it's good to see that we've got a bit more tenure here. So now, speaking of the crisis, we'll turn it over to Scott to describe his experience with the Reserve Primary Fund, which I think was one of the ones that broke the buck.
Yeah, it was interesting. The Reserve Prime Fund was one of the oldest and at the time largest money market funds that was available. And what was interesting about the situation there is they had 3% exposure to Lehman Brothers commercial paper. But as a result of, I guess, rumors and the understanding of their experience or of their holdings, there was a run on the bank. People saw that Lehman had gone under, that it was unlikely that the reserve fund was going to be able to collect on its 3% holdings in commercial paper, or if they could collect, it would be delayed. And suddenly there was a huge amount of redemptions on the fund. At that point, because there were so many redemptions and the reserve fund was trying to liquidate as fast as they could, they actually did what's called, they broke the buck. In other words, the NAV was no longer $1, and it actually fell at one point, I believe, to as low as 97 cents. In any event, at that case, at that point, they gated, which we mentioned before. So they said to the people who were trying to redeem, look, we can't fulfill all of these redemptions at this point. We're going to let things calm down for a week or so, and then we'll start providing redemptions again, which of course, if you had all of your money in the reserve fund, was very disruptive to those institutions. Then when things didn't calm down, then most of it, when things didn't calm down in terms of the redemptions, the reserve fund actually went into liquidation. And it took several years actually for people to get their money back. And as I understand it, people got back about 99 cents on the dollar over time. But again, that was a situation where you thought you had daily liquidity, and it turned out that, of course, you didn't.
It's great anecdote. And this is certainly the worst one, but I know I had an uncle who was a treasurer at the time, and he had money locked up for a week, something like that, and didn't have any losses, but not having access to your money for a week is a big deal. All right, so I'll turn this over to Sean to quickly go through the fund evaluation.
Yeah, sure. I'll be brief. We've covered most of these points already in some detail. I think, what we haven't really touched upon is the second point here, which is looking at kind of the technicals, if you will, of the money funds in terms of what their weighted average maturity and weighted average life are. And really the WAM, as it's called, is more of a reflection on the interest rate sensitivity that a fund has, and the wall is more around liquidity and credit. More of a credit gauge of the fund than anything. I would say, generally speaking, because money funds, they have some flexibility in terms of what they can invest in, even if it's like in this pretty prescribed universe of instruments. But typically speaking, in a declining rate environment, money funds, because they can extend out the curve, extend that WAM, can pick up a bit of yield over kind of treasury securities as those two things converge. So the rest of the stuff I think we've covered in detail.
Great. Okay, so last item that we'll touch on is direct ownership of T-bills. So previously we touched on T-bills as a component of money funds. Now we're going to touch on direct ownership of T-bills. And this is what we were referring to when we said Warren Buffett owns a lot of T-bills. He owns them himself, not through a pooled fund structure. And this is partly inspired, again, by the survey, where we saw that only 14% of the treasurers we surveyed currently invest in T-bills, while 66% consider it a safer alternative than their current setup. As Scott explained in detail, T-bills are one of the most liquid financial instruments that there are. They trade many billions of dollars per day, and the government is always issuing them because the government has to fund its debt. And historically, T-bills have been perceived as complex to trade and manage. And that's one of the things that Jiko has focused on, is making them easier and eliminating that complexity and making direct ownership of T-bills simple. But based on our survey, historically, people haven't invested in them because they're perceived as complicated products. They're securities. People believe that you have to trade them. Trading is complicated. You have to reinvest the proceeds on maturity, et cetera. So I guess I'll turn to Sean for a couple of key takeaways, and then we can hit on any questions that we have.
Yeah, look,
Chris, one thing, can I just jump in? One
Please.
thing that you didn't mention, particularly in high tax states, one of the also the advantage of direct ownership of T-bills is that they're state tax free.
Yes, great point. And a lot of people, I mean, we don't give tax advice here, but a lot of people might be unpleasantly surprised when they have to pay taxes on repo. They have to pay state taxes on repo, and they have to pay state taxes on agency securities. So T-bills are very unique in that sense. So thank you. Sorry, Sean, you can take it away.
Sure. Yeah. Look, I know we're short on time and want to save time for a couple of questions, but I think really what it boils down to is there's a lot of information, a lot of data out there to help make better investment decisions, and for folks to be more comfortable about where their cash is and how safe their investments are. Based on your survey results, we saw very few, relatively speaking, are very confident in terms of their cash security today. And we've discussed a number of ways that they can hopefully feel more confident in what they're doing. We always assume cash is cash and is always liquid, but cash and cash equivalents doesn't equal cash under the mattress at home, right? So being aware of where that cash is, what it actually is holding, and how liquid it is really does matter. And again, there's ways for folks to see what it entails. And then, just making sure that you're reviewing your counterparties. Like I mentioned, their bank balance sheets. It's an important thing people typically don't look at, particularly if you're looking at a non-G-SIB. And then, as Scott pointed out, who the funds are doing business with, what exposure might you have, as there's some brewing crisis out there. So I think those are kind of three important things that, like I said, there's information and tools available to help investors make smarter and safer decisions.
Great. That's fantastic takeaways for the audience. Okay, so next we're going to touch on some questions. We don't have many. I think we answered one. That was, what is a liquidity fee or redemption gate? Hopefully that's been covered. I guess next we'd love to know if maybe, Scott, you could touch on how have some of these securities behaved in times of crisis? So you talked about, obviously, the fund that you were in did not behave well, but just generally in times of stress, how do you think about how repo, T-bills, and government agency securities will behave?
It's interesting. During a crisis, that's often when you have the best bid for treasury securities, because people are moving out of risky securities and trying to buy the risk-free securities, the government bills and bonds. So if you're a holder of T-bills and you need liquidity during a crisis, that's probably the time when it's going to be easiest to sell, because there's going to be a really strong bid for treasuries. And in fact, you often see the yields go down because there's such a movement of investments from the risky investments to the risk-free investments.
100%. That's a flight to safety. Money leaves banks. It leaves risky places. It's got to go somewhere. And T-bills get bid up. So it's a good place to be. Thank you. I'm going to address another question. Maybe if Sean could talk to this. What are some of the operational hurdles that historically people have faced trying to buy T-bills directly themselves?
Well, yeah, I think if we think about our, like, kind of the core audience we're talking about from a corporate practitioner perspective, well, from a market infrastructure perspective, T-bills, just there hasn't been as much investment in terms of trading them, frankly, right? Like, I think most folks trading them now are going into Bloomberg, hitting a dealer directly, and then there's a whole settlement cycle that has to happen on the back end of that. And then once those, they either need to roll them or let them come off. So it's a bit, you mentioned it's viewed as a bit operationally cumbersome. And I think for a lot of folks, it tends to be because there just has not been a great market infrastructure around them.
Yep, fair. Thank you. Yeah, people think of T-bills as like stocks. You got to trade them. And certainly one of Jiko's goals is to make them look and feel more like a bank account. But historically, there's always been that friction. Scott, anything else you want to add on that?
Well, I guess the one thing I'd say is on some platforms, I guess I won't mention which, but there's some platforms where you can trade pretty easily online, but they're limited. So one I'm thinking of, for example, has a limit of 5 million that you can trade online. And if you want to trade a larger amount, you actually have to call the phone number, you have to wait online, you have to wait for however long the waiting period is and go through that process. And so it might actually take quite a bit of time to trade if you need to trade a large amount.
Yeah, that makes sense. And certainly, again, I won't name the platform, but the ones I've seen, you can trade them, but you can't wire against the T-bill. So the way they've had it structured is if you own a T-bill, you have to sell it and then send a wire, as opposed to having that be one seamless process. So I think that we do have one or two more other questions, and we will get to them, but we're out of time, so we might have to just get back to people through email, but we will get to all the questions, I assure you. And then post-webinar, look, first, I just want to say thank you so much to Sean. Thank you so much to Scott. Thank you to the team that organized this. This was a huge, huge amount of work went into this. And thank you for the audience spending their time to listen in. Hopefully people learn something. Hopefully they feel a bit more educated about how to protect their cash in times of crisis. That really was the goal. Again, administrative stuff, you'll get your CTP accreditation letter afterwards. That'll be emailed. You'll get the slides, and you'll get a link to the survey that we did and the survey results. If you're interested in learning more about Jiko, which is the company that's behind this, You can follow us on Twitter, you can follow us on LinkedIn, or you can click the Get in Touch button on the right side window, and someone will reach out to you. So thank you very much. Thank you for your time. Thank you for your patience. Thank you to the panelists.
No,
Thank you, everyone.
Thanks.